A splendid evening it is to viewers. Welcome to Equity News on Equity Access, your area of perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's go. The International Monetary Fund has released the World Economic Outlook for 2019. Key to the report is the fact that the IMF projects a GDP growth of negative 5.2% for Zimbabwe. Well, Zimbabwe, according to this particular report, appears to be in a recession. Well, let's get into the stats and let's have an appreciation of what the report actually says with regards to other parts of the world and, of course, what it actually says for the continent in that respect. Well, getting into sub-Saharan Africa for 2018, the figures reveal that there's an estimation of 3% growth in GDP, 3.54 for 2019. Question is, why is Zimbabwe in the negative? Well, getting on to other stats or other statements released according to the IMF, it says that global growth has softened by 3.6% in 2018 and is projected to decline further to 3.3% in 2019 and to return to 3.6% in 2020. Moving forward, advanced economies 2019 are projected to grow to 1.8%, while emerging markets and developing markets to 4.4%. Now, moving back to Zimbabwe, we registered a GDP growth of 0.7% in 2016, 4.7% in 2017, 2018. The estimated figures are set at 3.4% growth by the International Monetary Fund, while government says it was a growth of 4%. Now, here's where it gets interesting for 2019. The Zimbabwean government has set an estimated growth pattern of 3.1%, while the IMF then says, no, we expect a decline in GDP of 5.2%, juxtaposed to what the World Bank has estimated at about 3.7% against the African Development Bank at 4.2%. Well, for 2020, Zimbabwe expects a growth of 7.5%, while the IMF expects a rebound in terms of the growth to 3.3%. Moving on to our next story, following the launch of the interbank forex trading platform by the central bank in February, there are growing calls to allow market forces to determine the allocation of foreign currency. When the interbank system was introduced by the Reserve Bank in February of 2019, the RTGS dollar was trading at 1s to 2.5 to the US dollar, but at the moment it is trading at 1s to 3.13. As it stands as well, there are concerns that the RBZ may be manipulating the interbank market system by trading on the market so as to influence the pace and direction of the market. Meanwhile, a lack of transparency in terms of the value traded may also be affecting the participation on the market. However, the interbank system has not been liquid enough for businesses to access enough foreign currency for their operations. Economist and industry expert Persistence Gwanyanya shared with us his thoughts on the subject. Let's listen.
The first recommendation is for RBZ to revisit its pricing mechanism of foreign currency. One of the suggestions, like we are talking about tobacco right now, would be auctioning foreign currency. It's a suggestion, but clearly the exchange rate of 1:3 is not enough to compensate, is not enough to cause the market to abandon their current structures into the interbank market. Because the interbank market was missing, because the formal system was missing for a long time, our structures have already cemented. A company that is exporting is matching with a company that is importing. So they are exchanging foreign currencies among themselves. You cannot run away from the issue of the exchange rate. Yeah, sure. The exchange rate of 1:3 is too low to cause someone to trade his money in the market. When an alternative market is trading at 1:4.5, it can't happen. Or even when the structures that we doing between ourselves, which are lawful actually, which Reserve Bank itself was actually at one point encouraging, when they separated the accounts and communicated to the market that we don't have obligation to allocate you foreign currency. Look for your own foreign currency. So the first thing is to relook at the rate and the mechanism of arriving at the rate. We would want the market to speak to each other. We would want an interaction in the market. There is lots of foreign currency within the market. In the market, 600 million is quite a lot of foreign currency sitting in the nostrils of the companies here in Zimbabwe. But we are failing to tap into that supply. That is the problem. That is the major problem we're facing as an economy. What this tells you is that the economy is actually dollarizing instead of re-dollarizing. We are actually promoting a dollar culture. So you can't say on one hand you want to preserve your own currency, and on the other hand you are showing preference. Wherever there is dollar, you rush for the dollar as government. So what are you communicating to the ordinary person? So I don't see policy congruence. I don't see consistency in respect of what we want to achieve and what we do on the ground.
On the same subject, ZSE-listed plastic pipes manufacturer ProPlastics also expressed difficulty accessing foreign currency to stay operational from the interbank market system. Finance Director Mr. Pascal Changunda sheds more light. Let's have a look.
The forex. Well, yeah, we have applied. We didn't apply. We bid. We haven't been too successful. I think the amounts we've gotten are below 100,000 to date, ever since it started. I think that's all I can say.
And I think it was also important to add on, Pascal, that the last formal allocation that we got from the Treasury was in September 2017.
2017, yeah.
Sorry, just as a follow-up, what's your monthly requirements or your requirements on forex?
Pascal, monthly requirements on forex?
About 500,000. If I'm looking at the
It's
operation.
minimum 500,000.
A month?
A month, yes.
And you got less than that?
Earlier on, we engaged the former Finance Minister, Dr. Simba Makoni, on his perspectives on the interbank market system. Again, let's have a look.
Okay, then talking about the rates, let's talk about the interbank market system. How effective do you think that would be? I mean, we've seen Nigeria run the NAFEX. It seems as though we've borrowed one or two concepts from there. How effective do you think that would work for Zimbabwe?
I think the bottom line is really supply and demand. You can tinkle with the instruments on the periphery, but until you establish a balance or equilibrium between supply of foreign currency and its demand, I don't believe any instrument is going to contain the rate unless you put it on a free float, in which case it will go to a level that's dictated by availability.
Okay, so would you recommend the free float as the course that we ought to take?
It is the only practical route.
But given the fact that we don't have enough foreign currency reserves in the country, what would happen to them?
The rate will stabilize at a level that will be sustained by the supply and demand. It's not only supply and demand of the currency, but also supply and demand of use. So the market will sift high priority users who need currency. They will access it at a rate or a price that will sustain their business or their purposes.
Okay.
Well, Dr. Makoni also advised government to be strict in terms of austerity if at all Zimbabwe is to achieve the short-term prosperity. Again, let's have a look.
If we want to rectify the ills in our economy and in our society, austerity is inevitable. We have to exercise austerity. But will our government do so? I don't believe so. It's quite clear that from Tulingube, austerity for prosperity is just a slogan, because the reality on the ground is we are not living within our means and we are not cutting our suit according to our cloth. There is a lot of profligate use of scarce resources for the least important and lowest priority purposes. It was the same under Mugabe, it is the same under Mnangagwa. I don't want to draw this into a political debate, but the bottom line is there is not sufficient discipline in our government at the highest level to live within our means.
Okay.
In other business news, Cabinet has approved the proposal by the Minister of Lands and Agriculture to review the producer prices for maize, small grains, wheat, soybeans, as well as cotton. Here are the new prices. For maize, the price stands at 726 RTGS dollars per metric ton, wheat 1,089 RTGS dollars per metric ton, soybeans 918 RTGS dollars per metric ton, cotton at 1,950 RTGS dollars per metric ton. Well, according to a statement, it says in US dollar terms, the prices are now aligned to import parity prices in the region. Cabinet also approved the 38.5% subsidy on the selling price to millers to be maintained to prevent increases in retail prices. As we make progress, ZSE listed equipment manufacturer as well as distributor Zimplow released financials for the 2018 financial year. Zimplow is parent company to Millibrand, Pharmac, Powermac, Bazem, as well as City Bolts. It specializes in farming infrastructure and mining equipment and is regarded one of the largest manufacturers and distributors of farming artillery in sub-Saharan Africa. Well, they recorded a 25% growth in terms of revenue to $48.7 million in 2018 from $39.2 million recorded in 2017. Profit after tax scaling 76% to $6 million. Let's just get into a broader perspective of the stats from where the corporation is actually coming from. 2014, they were in the red, recording a net loss position of $3.09 million. 2015, their net loss position worsened to a negative $4.78 million. 2016, negative 2.53. There's a bit of an improvement there. Then in 2017, they record profit after tax of $3.45 million, as well as a growth in revenue to $39.15 million. 2018, quite a positive for them as they scaled to $48.69 million in revenue, as well as a net profit position of $6.33 million. Of course, that is profit after tax in that regard. During the year, Pharmac was recognized by the owner of Massey Ferguson Brands AGCO and won 3 awards for an outstanding performance across Africa. Notably is the fact that they now have a new chief executive officer, Bimbanya Kujika, and the group seeks to consolidate its sales in the local mining market as well as beyond. Meanwhile, Vast Resources, which is listed on the AIM market, has disposed of its gold assets while retaining its interest in diamond mining in the country. Vast Resources has concluded a conditional sale contract for the proposed disposal to Southern African Trade Finance, the SATF, of its non-core 50% interest in Ronco Enterprises, the holder of its Zimbabwe gold assets, as well as the remaining 25% interest in the Pickstone PLS gold mine and associated assets, principally the Eureka gold mine. Let's have a look at the whole motivation behind this particular move by the chief executive. According to the statement, the heritage concession will require significant investment, not only financial but in human resources, to enable near-term positive cash flow for the business. The divesting of the gold assets in Zimbabwe allows us to focus on all of our Zimbabwe finance and management on this key component of the company's growth. Well, the deal is of course subject to shareholders' approval on April 23rd, which will enable the group to refocus on its 2 growth opportunities, particularly in Baita mine in Romania, as well as the Heritage Diamond concession in Zimbabwe. Well, for a conversation on these and other issues, we will progress just soon after the break. We'll be joined by one of our investments analysts, so please stay tuned. Welcome back, viewers. I'm now joined in studio by Equity Access investment analyst, Mr. Tinashe Kadu. Tinashe, good evening and welcome to the show.
Good evening, Eben. Good evening, viewers.
Beautiful. Let's get the ball rolling. IMF has released a World Economic Outlook for 2019, and they're, of course, spelling out interesting details that I would just want us to get into. Well, Sub-Saharan Africa is expected to grow to 3.5% in the year 2019, against the background of Zimbabwe, which they've said that Zimbabwe should actually be in the negative at 5.2%. What is your comment where that is concerned?
Yeah, for Zim, Eben, it's actually a concern. Negative 5.2%, it means we are deeply in a recession, and a recession is a worrying, economic situation for us. And the major problem with the recession is it has domino effects, and if it's not managed properly, the effects can even snowball into major problems. If you look at recessions, what happens in a recession, it means there will be generally depressed demand, which needs a huge stimulus to kickstart, economic recovery. And stimulus can be in the form of monetary interventions and or as well fiscal interventions. So it means if we're in a recession, it means that a cocktail of policy measures that the authorities should implement should be actually diverting away from the austerity talk to real stimulus intervention for kickstarting the economy. That's a really source of worry, given depressed fiscal position of the government in terms of the government coffers. Then if you saw even carnage in terms of the exchange rate markets and even the weak reserves in terms of RBs, that is books, that's really a source of worry, and negative 5.2%. I'm really concerned.
Just to stop you in your tracks there, Tinashe. Earlier on, we saw the World Bank projecting a growth of 3.7%. The African Development Bank also coming in with a growth projection of 4.2%. And at this point, we seem to have what seems to be a contrary story, because also the Zimbabwean government has projected a growth in line with the World Bank as well as the African Development Bank. What has changed between when these estimations were actually presented and what we're seeing now? And why the disparity in terms of the assessment there?
Eben, when we had this change in government, it brought in, new sense of hope and new optimism. We had so much confidence in the new dispensation, and this confidence is not now being supported, by actual reforms at government level. We wanted maybe to see, policy consistencies and maybe seeing, funds trickling in and enough support from the international community. So this hasn't turned out well, and now these are now the effects, and confidence in the market has been eroded. Prices, they are rising on a daily basis. It's actually an economy in intensive care, which really need proper policy interventions at government levels to kickstart the economy.
Can we talk about the inflation? According to the same report, they expect by year end that Zimbabwe's inflation would have reached 40%. Right, against what the Minister of Finance has actually said. You see Professor Mthuli Ncube saying that we should reach single digit by year end. What is your assessment in terms of the two differing perspectives in that regard? Who's the better prophet in this particular subject?
Yeah, but I've done a quick run of my numbers, maybe trying to do a bit of some simulations, and I've seen if you don't grow your monthly inflation, it means by year end, inflation will be around 13%. There is no way.
If there is no growth.
There is no growth in monthly inflation. It will end the year by at and at 13%. But if there is on average a monthly inflation of, let's say, 1%, inflation will end the year above 30%. So the 40% IMF figure is actually conservative given the dynamics in the economy. I actually project maybe the inflation to be higher by year end, maybe around 89% or 73% there above.
I realize. Okay, now let's talk about what has been said there. Constant calls now to actually have the Reserve Bank allow for the market forces to determine the allocation of foreign currency, because with the system that we currently have, there seems to be what appears to be a semi-fixed exchange rate somewhat, because there are concerns that perhaps the RBZ could be manipulating the system by trading in the market, and also the lack of transparency on the market. And now there are perhaps calls to say maybe the RBZ needs to allow a free flow in that particular space. What are your comments on the particular subject?
My own assessment in the interbank market, you see, when the interbank market started, the RBZ injected seed capital of, was it 2.5 million? If I'm not mistaken, to quick start the interbank market. So it seems as if those funds have replenished, and the RBZ doesn't have enough reserves to support the currency. So when you don't have enough reserves to support the local currency, it means you only have one policy choice of floating the exchange rate. So that's where I see maybe the policy stance is moving towards. The government at the RBZ wasn't prepared in terms of having sufficient reserves that will work as buffers in protecting the RTGS dollar. So you see, but on the contrary, when you float your exchange rate, when you are moving away from a peg, generally your currency will go under speculative attack, or will go under attack in the the first phases, then might stabilize going forward, depending on the policy stance that you are implementing. But looking at what's happening in all markets, there is total carnage in all markets, and my fear is the central bank will have little choice, but rather grow the money supply, which may result in more exchange rate losses and inflationary pressures being compounded.
I realize. As we make progress, Cabinet has approved the proposal by the Ministry of Agriculture as well as Lands to review producer prices for maize, soybeans, and the different crops, or should I say different products across the board. What is the implication of such a move with regards to that particular sector?
I think this also points out, to the issue that I was explaining before, that it's an economy which is in serious intensive care. So you see, the government is really facing tough choices. If you increase benefits to the farmer, it means there is pressure to your money supply as well as your fiscal position. But if you don't compensate that farmer, you will be discouraged to undertake production, so production will go down. Then we will remain in that depressed state. So this is actually a difficult situation at government level, which the government is facing. It's actually tough times, and we hope maybe the coming farming season, government will get enough support.
Hold on a second. Let's get into the Dinsi Winces here. Yes. There's a statement that says that in US dollar terms, the prices are now aligned to import parity prices in the region. What does that mean?
When we moved to a managed float, it means that we have moved from that 1:1. Before, I think the import parity for importing maize was around 250 US dollars per ton.
Right.
And when we had that 1:1 exchange rate, it means that at 390 per ton, the farmer was actually cushioned and was profitable.
Okay.
So now, with the exchange rate now around at 4, it means that 1:4, 1:3, whatever you might want to call it. But I take it as 1:4.
Okay.
That's why I think it is maybe stabilized around, but with this hike in prices and producer price of maize, I project the rate even to surpass that 4 as well.
Okay, you are still explaining.
So with the move to the rate 1:4, it means that the 250 wasn't now the equivalent import parity, or wasn't the exact price that you incur, or the exact cost that we incur when you import your maize from markets such as Zambia or South Africa. It means you now be required to spend more. So now they've pegged that price, they've increased that price to an equivalent of 721 per ton for maize, and I know for soybeans it's above
$918.
It's $918. Cotton is above
1,950,
It's above
yes.
1,000 US. So the implication is they are just taking into account your exchange rate, the local currency, and your costs that you incur when you will be importing your maize from other markets other than Zimbabwe. But
So now government will need to print more money, to release more money out on the market, which would then have an inflationary effect.
I think I'll come to that. Maybe at the government level, what it means, they are actually offering a subsidy to millers. They are buying from farmers at 721, let's say for maize, 726 if I'm not mistaken, and then they are giving a 38.6% as a subsidy to millers. So the 38.6, that subsidy, that's the source of worry. Is actually the money coming out of government cushioning your consumer such that prices won't go up that rapidly. But already,
but we cannot rule out the inflationary effect that the prices have brought in.
Right. Yeah, because it's the past before this increase in producer prices, millers were purchasing grains from GMP at around 250 US dollars or RTGS dollars per ton when it was 1:1. But now, when this price has been increased to around, I think the calculations will give you something around 350. It means there is now an extra $100 burden to millers, which they can easily pass on to the final consumer. So I expect to see, your price of milling meal going up, and of other agri-related commodities. And this situation has also been further worsened, by these drought conditions that we experienced in this farming season. And I don't think, in terms of maize harvest, I don't think if we may reach the 1 million ton mark. So there is a huge deficit.
Tinashe, given what's just been painted from the prices, you look at what the IMF has actually said, it looks like Zimbabwe is headed for a turbulent ride. Well, we're just going to take a break. When you come back, we'll have a look at the performance of Zimplow. Please stay tuned. Welcome back, viewers. I'm now joined by analyst Aniso Chimbumu. Aniso, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Won't complain. You'd only get better yourself.
I'm very fine, thank you.
Fantastic. Let's continue with the ball. Before you take us into the stock market, just a quick analysis of Zimplow. What can we expect from the company going forward?
Well, these guys are coming from a position where they actually seem to have managed their business very well. They also have come across a an increment in terms of their sales volumes that have actually spared most of their growth in terms of their revenues and profits. Back before, when they used to make their losses, around about if we just have a quick look here, around about 2014, 2015, thereabout, they had a partnership that they had to dispose of or deconsolidate from with one company under the name of Tassi Limited, I think, if the name doesn't escape me right there. But that business was pretty much a heavy burden on the group, and they decided to dispose of that business. Once they did dispose of that business had a couple of other angles within it, which had Pusium pain within that the assembling company there. So those loss-making businesses there for them really weighed down the group. And then when they didn't dispose of those businesses, they did start expecting an improvement in terms of their numbers. Now we do realize that the revenues did come off between 2015 and 16. That's much to do with the reduction in terms of what they were actually making from all of their businesses, especially considering that they had disposed of that other arm of the group. Now coming into 2016, 2017, then they started realizing growths in their businesses. One of which in this year, Farmic did perform very well. Had a very huge, had about a 59% increase in their revenues, but only contributing around about 20%, 25% thereabout. The best performing business unit that they had in terms of revenue growth, if I'm not mistaken, it should be their Farmic. Sorry, it was Parmic actually.
Okay.
Parmic had actually gone up 116%. In terms of its revenue growth, but then Parmic is still pretty much the smallest unit. It only contributed about 8%, while Farmic is the larger contributing business in that regard. Now Farmic had a very good year in terms of their revenues being pushed up by a volume increase in their tractor sales. Where their tractors went up by about 75% to 216 units in that year. Now, this has much to do with the optimism and also the improvement in the farming season of 2018 that we actually did experience.
Okay.
So it does align with how their business has been performing in that regard. So going forward, we are expecting a little bit of some turmoil around our farming businesses. So I wouldn't expect much sales volumes going up with regards to company or farmers actually looking to expand on their machinery. There also are inflationary pressures that will be pressing a lot of farmers not to get into capital expenditure, unless otherwise. Then we could also look at their mining business. The mining business may have a little bit of a dim light there, because you would realize that not a lot of people are going to be very much interested, especially with how the government has been treating our miners as of late. So if those kind of policies do change, if the excitement and the encouragement around the mining businesses does come up, they could start experiencing an uptick in those revenues with that regard. But then with a lot of mining companies coming into Zimbabwe, I mean, you look at your vast resources there, being one company that is now really looking to focus on Zimbabwe. They should be one of those such companies which should be pushing up their mining's business side of Zimplow. So they are in a mixed situation going forward. Inflation pressures may be subduing most of their sales volume, but then we have new companies that are looking to come in into the farming side of into the mining aspect of Zimbabwe.
Okay, interesting to know. Now, please take us through the performance of the stock market.
All right, the stock market today was on the green side again, coming up for the third consecutive session in a row. The all-share index was up 0.57%, while the industrials index was up 0.59%. Now, the top 10 index, the market leader currently has notched up 1.07% for it to settle at 118.49 points, consequent to an in-score jump there by about 11.5% to 149.74 cents, while Old Mutual did, however, contribute to about 64% of today's value that was traded into the stock market. That value was around about $6.8 million. Did come up 0.62% for it to settle at 826.62 cents, while Padenga is back in the hundreds now at 100 cents after adding 3.94%. Just to have a look at an appreciation of our 5-day trend, this pretty much puts our all-share index 2.5% ahead of its prior week level of 121.56 points, while the all-share index is now up 3.7% ahead of 114.26 level there, about as it settled 118.49. The mining index pretty much stable again today. It has a tendency of sailing stable more than it has oscillations in its lifespan. So it is now down 0.81% on a 5-day trend, while the industrials is in a positive 2.55%. Now, for our risers and the fallers, in score we've already spoken about that. That was the biggest bull of the day, while Zimplow did add 10.2%. I suppose some investors are looking forward to improved revenues, probably coming into this year with a lot of mining companies that are going to be coming in. We've already spoken about that. It could improve their earnings, not knowing how much of the inflationary pressures is going to put on their heavier side of the business, which is the farming side. Now, FML did add about 7.76%, while Simbisa and Padenga caps the top 5 rises of the day.
Before perhaps you move on, Padenga cautionary statement issued on the ZSC. What can you shed more light where that is concerned?
Well, they haven't really given us much light as to what kind of business they want to get into, but they have mentioned that they are looking to diversify into another export business, which should increase their earnings and also foreign currency earning potential. So now, this pretty much puts Padenga in a very good position regarding how the earnings of the company are going to be recorded by the year end, or as and when the new business venture that they're going to be getting into, which should be revealed to us shortly before I think around about the times that they're going to release their financial results, or around the analyst briefing. And the analyst briefing scheduled. So it should push that price up. I mean, Padenga already has been enjoying a very good year. Currently, it is up on the year-to-date basis, northwards of 13% on the year-to-date basis, also giving them room for them to actually grow that grow that percentage, mainly because of how they have a very good potential, or rather they actually do earn in foreign currency, because most of their business is export oriented, and then adding on to the new business that they want to venture into. So it should be a very good perspective for them going forward. We are pretty much interested into knowing what kind of business they would be really getting into. Now, on the other end of the yardstick, Nampak was the worst performing counter of the session today, coming off 14.65% for it to settle at 30 cents, while banking stocks, CBZ, settled at 17.54 cents, for it to settle at about 2.56%. Now, Art has a couple of businesses, one of which is Softex, and another, Eversharp 15M, is another business that has settled at 9 cents, while it has added about 2.17% on its day-on-day performance. Cassava Limited, an Econet spin-off, which has much to do with their fintech and fintech businesses under Econet, the Econet Group, did come off 0.68% for it to settle at 108.78 cents, while Rio Zim, which is on the minings index, did come off by a very negligible number, around about 0.001%, settling at 177.15 cents. So that's pretty much the performance of the stock market today, with it registering about $6.8 million in terms of their value traded, which is about a 2% increase from the prior session. Now, for our interbank market, the interesting conversation that you had with Tinashe Kado earlier on, I'm also worried now, much to do with the interbank rate, where probably the government is going to be having a lot of pressure in terms of them actually increasing their money supply in RTGS, with regards to how they're going to be treating their farmers, especially considering that there's been an increase in most of the producer prices, going up with regards to how the foreign currency exchange rate is playing out currently. They did use a rate of about 2.7, yet today we are sitting at about 3.13. So that adjustment may come into effect later, but then knowing the government, they're going to hold it at around about that mark. So the pressure will come onto the government for them to increase their RTGS balances. So which should then put our exchange rate for the interbank rate at a weaker position. It may even breach the 6 ceiling that a lot of people were expecting, with regards to how they had been calculating it at RTGS money supply level of 1.8 billion versus a foreign currency balance of about 300 million, which gave them a rate of about 6. Now that rate may go may weaken further than the 6 that was expected, if the government gives in on the pressure that should come in, especially considering this whole new arrangement that the cabinet has pretty much approved on. Now, further, just adding onto how the interbank rate is going to perform, it should give the payroll market some extra room for it to grow beyond its new level of 4.3, while the old mutual implied rate is at 4.13, as the local bourse has gone up, while the JSE bourse also went up today. So that's pretty much for me and the markets today. I don't know if you have anything else.
Well, that's about it, Annie. So thank you very much for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From Anis and me, Danke, and ciao.